Hey everybody, this is Jim at SP500chart.com. It's a little bit after 6:30 on Sunday evening, September 8th, 2013, and we're going to take a look at the S&P 500 chart, see what happened during this past week, what happened specifically on Friday, and if there's any clue at all as to what this means for the week coming up, weekend days, or weeks coming up, actually. Before we do so, I just need to remind you, as always, that the website and the video are for educational purposes only, and nothing stated at the site or in this video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. And that your personal financial situation might mean how much time you have to invest. It might mean how what's a good way to put this? Even your emotional makeup. I'll give you a little hint. When people say you should not invest money that you're not willing to lose, I will change that. If you invest money that you cannot lose, you are almost, not quite, but you are almost guaranteed to lose it. And maybe I'll tell you why in just a little bit, but if your emotional makeup is not cut out for risk, then the markets probably aren't for you. Either that or find a good mutual fund or somebody to manage your money so you don't have to have your hands in it. But again, even though that sounds like sage advice, I am not a licensed financial professional. I'm just a guy who draws lines on charts. So hey, let's do just that. Okay, we are looking at a 30-minute chart. That means each candle on this chart is 30 minutes of trading. You can see that that we've had a number of support levels that have broken down, but here lately we've been seeing some resistance levels give up the ghost. For example, this was resistance that broke out on late Thursday, early Friday. We started the process of back testing this line. It was back tested on Friday, and we got a solid bounce. But maybe going into the weekend, we did see some selling at the end of the day on Friday, which you can see here is this little red downdraft. But in the grand scheme of things, this, we see a little bit of volatility all over this chart. I've mentioned before that I think the S&P could very easily, even if we don't turn around in a big way, it would be very likely and very normal for the S&P to come back and back test this broken line that broke on August 15th. That would be a very typical standard behavior. So let's see if maybe we get that. Now, there are potential patterns that we could be looking at here, but I think I'm going to wait until things firm up a little bit more rather than confuse the issue with things that frankly could currently go either way. In other words, I'm not going to call this an inverted head and shoulders pattern when all we have is a maybe left shoulder and a maybe not finished yet head. Or maybe it is a finished head, but we won't know until we get a shoulder whether or not we're dealing with an inverted head and shoulders pattern. It is possible we may be. And if that's the case, we would be looking for a move that would likely, if we get this pattern, should get up and take this neckline out to the upside, but we're not there yet. That's a possibility. So let's take a look at how the week unfolded. First thing it was a short week. And we ended the week right at where we were expecting. Well, let's put it this way: we ended the week at a support line. Now, I'll be perfectly frank with you. When we've had some selling and we end at a support line, I am not comfortable always saying, yes, we bounce here. The reason is simple. Because support lines break. And when you're in a downtrend, that's when they break. So we knew we were in a downtrend. So the idea was, if we could get above this orange line, then I think that is a much stronger sign than just coming down here. Now, that said, last week I did go long in SPY. I didn't want to do a leverage thing because it looked maybe a little dicey. So I did something to where if I have to stay in it for a while, I'm not going to get eaten up by the natural decay of the leveraged ETFs. SPY will not decay the same way that the 2x and 3x bull S&P ETFs will, and especially the way the bear funds do. Those bear funds will eat you alive if you have to stay in them for anything more than just a handful of days. So be careful of the inverse leveraged funds. If you want to go short and you want to be safe, I would suggest putting more in just the straight inverse to SPY. And they're different ones. But anyway, what we saw was a move over this orange line early on the 4th, and that held up all week long. We got this pretty significant back test. The S&P actually on Friday plunged from a little over 1660, plunged more than 20 points in no time whatsoever. And I'll remind you, I think we're dealing with a market in which, in which the noise being created by the news in the Middle East is at least partly responsible for some of these little juking and jiving moves of 1% or 1% and a fraction. I just think that's where we are. So we may see more of that this week because, we don't know. We just don't know what's going to happen there. The market doesn't know. And any little clue that the market gets that looks good, we're going to gap up. Any little clue we get that looks iffy, we're going to gap down. It's going to happen. What we're looking for is for some reasonable action of trend lines to hold us when we do go down, or to resist the move when we go up. So currently we have two lines of support. We have this descending line that gave us a nice bounce early on Friday. And then we have this rising line that tried to break 1, 2, 3 times, and it didn't. So I think that bodes well for the S&P being able to, even though there's going to be likely some more noise, it looks to me like we're going to come up and probably test this 1670 level. And if that fails and we get a little sell-off action here, it would not surprise me one bit if we see an inverted head and shoulders form here that would have a target of about 1716. That just would not surprise me. And we're getting the kind of action that has in the past set up such a move. And that is, most importantly, we have a downtrend. The last dip out of the downtrend becomes the head. Then we break the downtrend, but then have a little bit of back testing weakness, at which point we form a right shoulder. And I'll remind you, the past couple of patterns you've had like this, the right shoulder hadn't been much. You remember, we actually had one pattern where there was no right shoulder. As a matter of fact, this is the neckline of that pattern, and for technical reasons, maybe this is a delayed right shoulder, if there's such a thing. I probably shouldn't say that, but here's our left shoulder and here's our head. We broke out and we never made that right shoulder. Maybe this is our right shoulder. That's just an idea. It probably isn't a very good one, but I throw it out because it sure looks to me like the S&P is finding support right here around the 1630s, and had we come up and then come back down, we probably would have come down to about the 1620s, 1630s on this right shoulder. So maybe that's part of what's going on. Again, looking at a 5-minute chart, I'll be honest with you, there's not a whole bunch to point out here in the way of small patterns. Oftentimes we will have little flags, little bear flags, little bull flags, but because the market is being jerked around so much by the news cycle with Syria, I think before any little consolidation pattern like that can develop, it just looks to me like there's some news item that just interrupts that process. So let's cut to the chase. I think we may see resistance up here in the low 1670s. If we get through that, I would definitely expect some resistance up here at this neckline. But that doesn't mean it's impervious, because I'll remind you that that neckline has met the pattern that formed this neckline has met its minimum expected move. So we can't really say that when we get up here we expect the market to fail and to start heading back south in a big way. If we had only made a third or a half of the minimum move, then we pulled back to this, then I would say that's a good point to sell. But because we broke this line and have already made the minimum target, I don't know that we can make the statement that we should sell here. And when I say sell, I probably should say sell short. I don't think that we can have the same degree of confidence in what would happen after a tag of this line now than we would have had we not already met that minimum expected target. However, that said, if we form an inverted head and shoulders pattern here, I would look for that 1717 to hit. If we don't form an inverted head and shoulders, and we just kind of tool on up here, I would probably, personally, I'll probably close out my SPY position. I just think it'd be the prudent thing to do. So guys, there you have it. Interesting chart. We broke this resistance line here, back tested it. That should tell us this market is willing now to enter a new bullish short-term phase. And let's see if we get it. this week, starting September 9, 2013. Now, if we do start the week out on selling, let's look to this line and this line as a good spot for a bounce. So, there you have your video for September. Actually, the video is being done on September 8th, but it's for the week that ended September 6th, 2013. I want to thank you for watching. Take care, and let's see what this week holds for us.